Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool that makes researching stocks easier and faster than ever before. I'm also the co-founder of the Dividend Kings website marketplace service on Seeking Alpha. And also, many of you know me as Mr. Valuation. Now, with that in mind, one of the things that I'm really struggling with here recently is I'm trying to find value in what I consider to be an extremely overheated stock market. This is the S&P 500 going back to 2001. The orange line, for those of you who haven't watched these videos before, represents what I would consider to be the intrinsic value of the S&P. The blue line is what we call the normal PE, or it's really the multiple that the market has most commonly applied over time. And these are numbers, you attach numbers to those kind of things, like the normal PE for the market going back to 2001 has been 17.75. But I want to remind you, that's comprised of PE ratios like up here in the 20s. And then, of course, we're up here in the 27 blended PE ratio that we have currently. But it's also comprised of PEs in the 10s and 12s, and even during the throes of the Great Recession, the PE did get down of the S&P 500 to only 10. All right, so it's an average of these numbers. Some will be higher, some will be lower. I want you to always keep that in mind. Statistics don't lie, but statisticians can be darn liars because it's really just mathematical relationships. But regardless, we're looking at an extremely high valuation for the market right now. And the last time we had a high valuation like that, it led to the lost decade. When we had really good valuations, it led to what has now been the longest, bull run in perhaps history. And, all bull markets end with a bear market and all bear markets end with a bull market. And as I pointed out in other videos, bear markets tend to be rather short-lived, like you see here, and bull markets tend to be much longer. And again, this is one of the, extraordinarily longer bull markets we ever had. But the point is, it's extremely hard to find value when you have a market like this. But there is value to be had. But now, when I'm looking for value, I'm also looking for a certain characteristic of stock or businesses that I like to own. The more consistent, the better. So here, we're looking at 3M Corporation, iconic A+ rated industrial conglomerate. Everybody knows them for their Post-it notes and et cetera. But the point is, I like companies that produce these very consistent records of earnings growth. Now, 3M, had a little bit of a drop coming out of the Great Recession, very minimal relative to its, historical production. It's had a little bit of disruption during COVID, but generally the earnings of this stock have risen dramatically. Now, the market likes to put a premium valuation on this stock, ergo the blue line that I referenced earlier in the video. But when I put price on the graph, I want you to note that 3M is once again very overvalued. It got really overvalued into 2018, got very inexpensive, and now it's overvalued again. So here we have a really good, high-quality blue-chip dividend growth stock that is a little too pricey for my taste. But I'm looking for companies with this kind of characteristics. Johnson & Johnson would be another example. It has a very consistent record of earnings growth. They did have a little bit of an issue in COVID, but very minimal, relatively speaking. When I put price and the normal PE on here, I once again discovered that now Johnson & Johnson has become overvalued. So although this is the kind of company that I truly covet and truly want to invest in, especially, AAA rated with low debt, I won't invest in it today because the valuation is too high. And then finally, I look at a stock like Church & Dwight, which has one of the most quintessential records that I think I've ever seen a company produce. Earnings growth has been consistent year after year after year after year. I also want you to note that this white line is a plotting of the dividends, and the area below this white line is the dividend payout ratio, the portion of these total earnings, the dark green shaded area, that the company pays out. This is another characteristic I like to see in companies where the company had a relatively low payout ratio in the teens here, 12 and 13% payout ratio, percentage of earnings paid out. But then that payout ratio began to increase as the company's growth rate perhaps began to slow down a little bit. Okay, but that's a characteristic I like to see because now the company is rewarding me more through dividend income. But again, the problem I have is extremely high valuation. Even though the market has put a premium value, historically put a premium valuation on Church & Dwight, it's gotten bizarre right now. It's to the absurd in my opinion. Great company, exactly the kind of company I really long to find to be able to invest in. But the reality of it is the valuations of almost every company that has these characteristics today that I'm looking at and evaluating are significantly overvalued. So what am I supposed to do? Well, I'm looking for value anywhere I can find it, and it requires perhaps a little bit of a compromise. So what I have come across is a very interesting company called LyondellBasell. And LyondellBasell is very interesting. The company came out of bankruptcy and went public in 2010. In 2018, they purchased A. Schulman, another specialty chemical company or commodity chemical company, as LyondellBasell is now considered. They, of course, had some decimation with COVID, but what this COVID has done, now there's lots of examples, and I might cover more of those in future videos, of companies whose earnings were hit, not necessarily due to bad management, but basically as a result of the pandemic, but then whose businesses have also been transforming, and this is what I would call a recovery situation. Okay, now, historically, once I get past the IPO year or the coming out of bankruptcy, going public again year, the company's averaged 13%, but it's been reasonably consistent for most years until we kind of came into COVID. But now we've got this explosion in earnings. I'm going to talk more about that in a moment. And what that's done is, originally, once COVID hit, the stock fell dramatically like many others, got down to a PE of 5, I might add, which would have been a very high indication that it was a great value, but it was also during a time when earnings were falling. So that's trickier than 2020 hindsight leads us to believe. Anyway, regardless, since March of 2020, the stock has gone up more than 100%. In fact, it's actually been a pretty strong performer so far, this fiscal year. So we've seen some really nice performance, up about 20% so far this fiscal year. But here's the point that I want to get at. This company is changing. This is a recovery situation. Now, there are characteristics that I still like about this company. For one, it's a dividend contender. And a dividend contender is on my associate at Dividend King, Justin Laws, who's the curator of the CCC list, the dividend champions who raised their dividends for 25 years consecutively, the contenders who've raised it for 10 or more years, which LyondellBasell is, it's a dividend contender, and then challengers, which are companies that are kind of the next coming dividend stars that have raised their dividends from 1 to 10 years. Okay, so this one's 10 going on 20. It's raised it for 10 consecutive years. That's the white line in this graph, and you can see that dividend has gone up very nicely. But what's really interesting about this, so there's a consistency that I like, regardless of the fact that the company's had some earnings issues. When I look at the performance of this company, I see a couple of other things that intrigue me very much. Number one is the dividend growth rate has been very, very strong, averaging over 31% a year on average, compound average growth of over 25% a year. But it's been, as often is the case, kind of a lumpy growth rate, if you will. Coming out of the first year when they came out of bankruptcy, they started out with a 55-cent dividend. They tripled it almost, raised it up to 163% to $1.45. And then they raised it by 38%, 35.12. And then they had a couple of slow years, increased it by 12. And then in 19 during COVID and 20, they only raised it by 3.8 and 1.2%. But I also want you to notice their dividend payout ratio has been relatively steady at around 35% or so. It bumped up to 75%. But again, that was during COVID when the earnings actually came down, where the payout ratio and the dividend even didn't grow very much. So what really distorted the payout ratio there was the idea that they had this dropping dividends. But here's the real kicker. Look at the explosion. The company's earnings growth is expected to be 159% for 2021. And we already have booked one quarter, and we're deep into the second quarter of that happening. We're expecting no growth in dividends this year, but I do believe with that streak on the line, we might see a modest dividend increase, which is yet to be determined. We are expecting a dividend increase. Analysts are forecasting a dividend increase after that. But I want you to notice this big surge. So if I use the 10.09 normal PE that this company has traded at instead of the 15, which I think it ought to be trading at, I think part of that explains the fact that the company came out of bankruptcy, obviously, and the market has kind of a jaundiced view, if you will. But I see a company growing at 13% a year easily worth a PE of 15. But not going there, if I consider I stay at a PE ratio of 10.09, and the stock does give me the earnings growth that the analysts are expecting this year, that's a 65, just under a 65% rate of return, annualized rate of return that I could make between now and the end of the year. It would actually be about 34%, pure growth, plus dividend income, pushing it to about 36% return just for the remainder of this year, annualizing it over 65%. Now, I want to go into that a little bit, and I want to show you some things here that I think are very, very important. So I'm going to go to the normal PE, and I'm going to go ahead and utilize that long-term 10.09 normal PE, because I do believe that's very realistic. And that gives us that, 64% annualized rate of return that I just showcased here a moment ago. All right. But there's also a possibility this company could trade at a 15 PE with the growth rate exploding as much as it is, which would be just, that would give us like 100% return by the end of the year if the stock ended up trading at a 15 PE. That's a possibility. This is perhaps the more likely scenario, admittedly, okay? But the reality of this is, if you look at this company, I want you to also notice something else here that I consider to be very, very encouraging. 6 months ago, analysts were expecting $7.20 of earnings for 2021. 3 months ago, they ratcheted that up to $9.43. And the most recent estimate now has been $14.45, which has further increased to the current estimate of $14.45. Now, I want to show you something else. If I go here and look at Yahoo estimates, I get very, very similar numbers for these next 2 years as far as earnings growth is concerned. But what I really want you to focus on is the next 5 years. The Yahoo analysts, who I think get their estimates from Reuters, where I'm getting them from FactSet on the fast graph, are expecting just under 40%, 39.7% estimated earnings growth for the next 5 years. So if I go to the custom calculator here, and I go ahead and I add the recent estimate data, just to be conservative, keep that number the same, even these next two numbers the same. But then if I put in the 39, I'll round it down to 39% just to be a little bit conservative, and look at what this company's earnings forecast could be, assuming these analysts are correct. There could just be an extraordinary long-term rate of return here. Now, there are some factors that make this all plausible. Number one is the company acquired A. Schulman in 2018. That was a major acquisition for, I think it was $3.5 billion, if I recall correctly. They've also entered into several joint ventures, and I talked about those. Or you can go into research reports and see joint ventures with all kinds of entities, including China, that have made this stock really interesting. I'll get into the company's website here a little bit in a second, but the reality of it is there's an awful lot of potential because this company is evolving, and it's evolving dramatically, and the company's, obviously being forecast to have an explosion in growth. Now, I also want to talk about some issues that the company has, because I think it's only fair to do that. So if I look at total debt and long-term debt, of which most of the debt is of their total debt, which is the mustard green color here, is long-term, which is the dark blue. And of course, this is the dividend coverage. They've got really great dividend coverage. Management has committed to reducing this debt dramatically. And if I look at it from a quarterly point of view, they've already started to do that. Another thing that they've done, which I think is very important, is the company's been actually buying back their shares, trading at these 10 multiples. This has probably been a good source of the company's cash, and they've probably borrowed some money to do that, but I think the biggest borrowing was to make that A. Schulman acquisition, as I understand it. But another thing that's allowing them to do, I do want you to notice that their capital expenditures are actually changing. If I look at it quarterly, I want you to see here that their capital expenditures have been dropping dramatically over about the last 5 or 6 quarters. So that's going to lead to probably greater profitability, as perhaps what these analysts are seeing when they're looking at the company. But there's some other aspects of this company that I think are also worth looking at. When I'm looking at dividend coverage, one of the things I always like to do, and I talk about this quite a bit, is I like to go into the company and look at operating cash flow, because earnings are optional, cash is cash. And of course, cash is what companies really pay their dividends with. So what you see here, even despite the COVID, where we had a drop in operating cash flow, the operating cash flow was significantly covering their dividend, which is this white line here. Now, another thing I like about this company, it's also been a very strong free cash flow producer, which is really the acid test. Now, free cash flow did get kind of dicey during COVID. They still were able to cover the dividend, but now we've got this expectation of really strong free cash flow growth going forward again, which again, I think gives me a real comforting feeling that not so much from a valuation perspective, although I do, I can look at this as another valuation metric. What I really like about this is the idea that my dividend is covered, and I feel like it's very secure and I could continue to get that increase. And again, it's yielding about 3.83% currently, which is attractive. If I get any dividend growth, if this company is able to grow the dividend, commensurate with what we saw on the custom calculator earlier when I was looking at earnings, and I, put in the custom number there for you, this could be really, really extraordinary from a standpoint of future rates of return and future potential. Now, there are some challenges with the company. I do think they have maybe a little more debt than I'd like to see, but management has really committed publicly to reducing that debt. They call it a major priority of theirs. So I really like that a lot. The company could really strengthen themselves. Their earnings expectations, they've really revamped their whole company. And let's go ahead and go to the company's website and let's look at a couple of points here before I close out this video. They're in chemicals, polymers, advanced polymers, various fuels, liquid natural gas being one of them, and then also technology. So this is a pretty well diversified, what we'll call it, commodity chemical company. Now, if I go into investors, they also have, these investor presentations. In their most recent JP Morgan presentation, they actually produced some slides here that I think are very, very interesting. They are really increasing their business and their business scale and their business results dramatically by going into all these new joint ventures and these new product offerings and so on. So there's a lot you can learn. I'm not going to go through all this with you now. What I'm saying is go ahead and go into, the company's website and look at some of these presentations. They have several here that will give you some really strong insights on how the company is actually improving and some of the initiatives that they've, generated. And by the way, I'm in the process of conducting my own due diligence on this company. I've not completed that yet, but I am pretty deep into it. I've gone deep enough to go ahead and add the company to my own personal income buy list. I like the current yield. I like the earnings yield, or in this case, the EBITDA yield or the operating earnings yield. I like the dividend yield. I like the fact that the company's improving on almost all aspects. I do consider it a turnaround situation. It is trading at a very attractive valuation, and with even moderate growth going forward, it could be real attractive. I do want to go to the analyst scorecard for a moment and show you something else that I think is important. When analysts have been making the forecast since they came out of bankruptcy in 2010, 1 year in advance, they've been right on most of the years until COVID came along. Okay, so you have to kind of take that into consideration. They've been almost better if you look at their 2-year forecast going out. They've really hit them on the head. Now, I do give the company a 20% margin of error when I'm doing the 2-year forecast versus only a 10% margin of error when I'm doing the 1 year. But the point is, this company has been giving analysts good guidance. That's one thing I can surmise from that, number one. And number two is, it's probably a pretty easy company, apparently, for these analysts to estimate, or the company just gives great guidance. Nevertheless, the forecasting has been pretty reliable, and I really, really like the fact that the forecasts have been increasing and increasing rather dramatically, over the last 6 months or so. So, and there's a possibility that could even drive this up to these higher valuations. So this is an interesting, I would call it a turnaround situation. In that regard, it has a little speculation involved in it. But I do believe this company has the attributes that make it a worthy investment candidate. I do think a few months ago, this company was not perhaps looking that attractive when the earnings estimates were down to $7 a share. The valuation at that point looked very high, but that's changing, and it's changing rapidly. And consequently, I've added this to my core income buy list that I would use for client accounts and for my own account. And I'm really considering starting to use this into my income portfolios. And, it could be a replacement for some stocks that I'm coming out of. Again, the yield is about 3.83% currently. and I do expect it to increase over time. Anyway, it's been Chuck Carmel saying thanks for watching. Hope you enjoyed this. I've enjoyed presenting it as always. Give me a like if you do, ring the bell, and subscribe to the channel if you haven't already. I've got a lot more of these coming. I might be covering some more recovery stocks because these recovery stocks are actually getting quite interesting. Anyway, thanks for watching.